And welcome back. In this next video, I'm going to discuss briefly the next ratio, which is the enterprise value to EBITDA ratio. Now, this sounds a bit scary because it's pretty large terms, but let's make it simple. And it actually is very simple. The idea here is we take the enterprise value and we divide it by EBITDA and we get the ratio. But obviously the next question is what is enterprise value and what is EBITDA? Enterprise value sounds intuitive. It essentially is a way of understanding the size of the company. So the larger the company, the larger its enterprise value should be. Why don't we take assets? Well, that's one way of knowing the enterprise value. But in this case, we will take the market value of the company. So assets, like I said, anything that is written in the financial statements is actually the book value, which can be very, very old. So we are trying to understand the value of the company from the market's perspective, as in the current value, not the book value. We can find the market value of a company by taking the market value of the equity and then the market value of the debt. So these two right here, these two combined are the market value of the debt, and this one is the market value of the equity. Right? There's one additional thing about market value of equity is that in the last video I had said that it's simply the stock price. It's the market value of a single share. That is the stock price. But if we're talking about the market value of the entire equity of the company, then we do take the share price, of course, but then we have to multiply it by the number of shares. That is the market value of the entire company's equity. So let's move again to the other sheet that I've got here. We can't take the book value of equity. This is the book value of equity, so we can't take this. What we will have to do is we take the share price and the number of shares. So if we multiply these two, we'll get the market value of equity. Let's multiply these two. Now this big number is the market value of equity, much larger than the book value of equity, right? So that's essentially the reason why we are doing all of this, because we can understand that there might be some difference between the market value and the book value of the company's equity. How about the market value of debt? We need debt, this part here, long-term debt. So market value of debt would be these two numbers combined, right? There's debt here, the long-term debt, but there's also some short-term debt that this company has taken up. So we add these two, and this number is the market value of debt. There was one additional thing we needed to do was we had to take cash, right? Cash and equivalents, let's just keep it simple. We needed the cash. Right? And we need to subtract that. So we need these three things, right? The market value of equity, market value of debt, and we need to subtract cash. So if we can do that calculation right here, that would be the enterprise value. Let me add these two up. This is the overall market value of the company, and I do a minus cash here. This number is the enterprise value. But the ratio wants us to divide this enterprise value by EBITDA. And we have to get EBITDA from the income statement, which is right here. So EBITDA is earnings before interest, taxes, depreciation, and amortization. And we don't need to do any calculations to get that number. We have the denominator right here, the numerator right here, and the ratio EV divided by EBITDA will be this number divided by this number. Let's see if I did the calculation right. I just need to compare it with the number given in the slide. 7.71 is my answer, and yes, it matches with this. So that's how you calculate the EV to EBITDA ratio. There's one additional thing that you need to keep in mind is whether or not this ratio should be higher or lower. So in other words, is a higher EV to EBITDA ratio a good thing or a lower one a good thing? Well, again, from the company's perspective, yeah, it should be higher. Why not? the company would want its size to be higher despite of having low earnings. But from an investor's point of view, you don't want the company to be too large, and you want the company to be making good profits, right? So smaller ratio is a good thing from an investor's perspective. Thank you.